Our session on building a real-time retail-centric bond market, challenges and tech solutions. I invite each and every one of you, ladies and gentlemen, to kindly get your hands together in warm applause as I invite our illustrious panelists on stage. We have amongst us Ms. Aditi Mittal, co-founder India Bonds. I'd like to welcome her on stage. Let's have a nice warm round of applause, ladies and gentlemen. I'd also like to invite Mr. Ajay Manglunia, Executive Director, Capri Global Capital, former MD and CEO, JM Financial. Welcome, sir. Thank you for joining us. I'd also like to welcome Mr. Prashant Vagal, Chief Operating Officer, National Securities Depository. Welcome, sir. And I'd like to invite our moderator for this session, Ms. Maninder Cheema, Executive Director, Securities and Exchange Board of India. Welcome, ma'am. I'd also like to welcome Mr. Tirth Shah, founder of Fixed Income. Welcome, sir. Thank you very much. Let's hand over to our moderator, Ms. Maninder Cheema, ma'am.
A very good afternoon to all the participants and to my esteemed panelists. Corporate bond markets have been on the horizon and being talked about for the last more than a decade, almost 2 decades. And over the years, a lot of steps have been taken to develop these bond markets. Just to give a sense of perspective, 10 years back, the issuances in the corporate bond markets were roughly around 5 lakh crores annually. Last year, it was 10 lakh crores. Again, to give a perspective, the issuances on the equity side last year were 2 lakh crores. So this gives an estimate of the size of investment opportunity in the bond markets. What is also interesting is that this entire 10 lakh crores goes to institutional investors. The retail participation in this issuance is less than 2%. So what's relevant here is the retail missing out on something which the institutions find very attractive? Are they missing out on a reasonably safe and predictable investment avenue? And what can be done to make this avenue available to the retail investors? SEBI has taken a lot of steps. To name a few, we started with electronic bond platform, the EBP, for bringing bond issuances. Then there was the RFQ, request for quote platform for secondary trades. And then SEBI gave permission to the OBPPs, the online bond platform providers. Having said that, the volumes on secondary market bonds still are very low at a daily of, in the last 3 months, around total volumes 18,000 crores, the RFQ platform 6,000 crores. Given this background, my question to the panelists is, the first question, why should investors look at bond markets? So Ajay ji, if you will start.
Thank you, ma'am, and a warm welcome. It's a very relevant question, why one should invest in the bond market. Equity market, as we all understand, gives you fantastic return, but that's only the good part and the glory side of the investment theme. But you don't focus on where the people have been losing on the equity market side. Like potentially if somebody makes a mistake, he may lose out the complete investment amount in the equity market. I'm not trying to resell. Most of the people have made the fortunes in the equity market if they have done very carefully investments. On the debt side, the bond market gives you a very safe, steady, and a normalized return over a period of time. It is not so risky. If you take your bets carefully, there are enough tools which are built around to choose out of the potential investment options available with you with respect to sector, with respect to safety by way of rating parameters, with respect to the ability of the issuer to service over a period of time. You have all, like from Government of India papers available to retail investors directly through the RBI portal where they don't need to pay any charges, not even charges for opening a SGL account, which all the institutional investors need to pay. So retail is given a very preferred treatment. I would say the online bond platforms have done a wonderful job. There are near about 41 online bond platforms. All have opened after the COVID. There was a need to reach out to the retail investors. People can't go to home to sell bonds. So providing all bit of information about any offerings, options available in the market at a competitive pricing, that's what the retail has an option today. By way of investing directly into the bonds, they are kind of getting superior returns compared to the all options available like fixed deposits, post office saving schemes, or whatever mutual funds and all of that, which indirectly comes to the bond market. So the spread which all of those people have been kind of retaining to invest in the bond market and give a return to the retail is what can be avoided. The retailers can get the superior investment, but they need to walk through the journey very carefully, read it carefully, all the information, thanks to SEBI, that they've made the process so seamless, they made the transparency in the system so well, the security are credited to the investor's account, and the money is taken out only when the securities are available with the exchange clearing system. So it's kind of a secured settlement system. Nobody can run away with the money or security. So all of those things have been done. What is lacking is that this needs to be communicated, this needs to be understood well, and that is what the online bond platforms day and night have been doing it. So I would say that diversification, capital preservation, inflation protection, steady income stream, stability, and the lower risk are the basic features in the bond market.
Thank you, Ajay ji. I want to pick from your reference to fixed deposits and post office deposits. Now, the size of those markets or those investment avenues is huge, whereas corporate bonds is very small. So, my question to Aditi and Tirth is, what are the avenues available for retail investors to invest in bonds? Why is it that they still go in for FDs and post office investments rather than bonds?
Thank you, ma'am, for the question. So let's put it this way. I'll just take it forward from where Ajay left. All of you invest in bonds, but in an indirect form, because all of you invest in mutual funds. I'm sure everyone who's sitting here, either themselves or through their family members, are an investor in a debt mutual fund. If you're an investor in a debt mutual fund, the underlining is bonds. Where do they invest? They invest in G-Secs, they invest in corporate bonds, in T-bills, etc. When you invest in equity mutual funds, where are you investing? You are investing into equities. However, at the same time, you invest in direct equities also. So what we have been proposing, or with the help of the regulator, we have tried to bring that asset class, which is called corporate bonds, G-Secs, SDLs, T-bills, to you directly to invest and understand that when you are investing in other financial assets, this is also an important part of your portfolio. Very interesting that FD and post office, I think each household in India knows what is a fixed deposit and what is a post office fixed deposit, or I would say Kisan Vikas Patra, because generations after generations, they kept on getting educated. It was easy to access. They knew what they were getting, and what they actually wanted was a fixed rate of interest. जो हम बोलते हैं, जो हमारे पिताजी या हमारे ग्रैंड पेरेंट्स बोलते हैं, मेरे को मेरा ब्याज आ जाए, मुझे उससे ज़्यादा कुछ नहीं चाहिए. So to our generation, as we have progressed, why don't we look at more progressive way of investment, and that's what is corporate bonds. As of today, what your avenues are, for your G-Secs, you can go to the direct retail platform, which has been started by RBI. Under the guidelines of SEBI, there are what is called as registered online bond platform. And one needs to be very careful that they only invest through the registered online bond platforms. They have to follow certain guidelines, which has been laid down by the regulator in the interest of the investor. Third way is the public issue of bonds. This was also a great initiative by the regulator, just as you have public issue of equity. Because what is a bond? Bond is a methodology in which a corporate comes and raises money. And why should it be limited to the institutions? Because people like you and us can also contribute towards the investment in a corporate which has a good pedigree, who is willing to borrow money and do the business expansion. So the easier way to reach out to the masses, regulator came out with the concept of public issue of bonds. That's the third avenue. And the fourth avenue is your secondary market. So you can go to the exchange platforms. From there also you can buy and sell bonds. So अगर आपको equity समझ आता है, direct equity, उसका fixed income version जो है, वो bonds है और उसी तरह trade होता है, the way the equity trades on the stock exchange. So that would be the various avenues how you can source bonds or invest in bonds.
I think so. Aditi has covered most of the points. But one thing I would like to add here is, since ages, I think so, Indian household has always believed in capital preservation. A SEBI report said that 80% Indian household still wants their money to be in an instrument which preserves their capital. So I think so bond becomes the best avenue as of now for every household to invest to get that capital preservation. I still remember whenever in every Indian household there is some good news, father or mother said कि पैसा जाके FD में डाल दो. I think so 5 years down the line, it should be पैसा जाके bond में डाल दो, and that should be our motto today. Thank you.
Thank you, Aditi and Tirth. Prashant ji, I have a question for you from the depository's perspective. Holding a bond is no different from holding an equity in the DMAT system. Would you be okay to share some information on the DMAT holding in depository system on the bond side, and any benefits which accrue to investors because they are holding bonds in the DMAT system?
Definitely, it's a good point. So basically, as we have discussed since this session has started, the bond offers the benefit over the various aspects. If it is a compare with equity, there is a capital preservation, stable income, predictability of the incomes. If you consider bank FDs, then definitely the returns are more, and the benefit of bank FDs are already there in terms of capital preservation and something. So it is very essential at this stage, but traditionally the bond market is the institutional market. And when we look at the DMAT accounts, we have seen the same trade continuing over the period of time. But the recent development in terms of price discovery and liquidity coming out of because of the RFQ platform, and definitely because of the avenues made available by the OBP and Fintech players, we have seen the traction has started increasing, but still it is very low. So today when we are looking at a open value of 55 lakh crore, hardly 56,000 crore worth of the bonds are held by the other than the institutional investor, which is hardly 1%. Now, if you look at a number of the participants in terms of the investors, there are hardly 18 to 20 lakh investors who are holding the bond, including the institutional investors. And out of that, around 15 to 17 lakhs, which varies, are the retail investors. Now the retail investors, today we have a 97% corporate debt market held in demat account in NSDL. So it is similar to the whole depository universe what is presently in India. Now out of this 15 or 16 lakh demat account, the more than 41 years age are 10 lakhs. So two-thirds of the population investing in the bond is actually the people who are moving towards their retirement age, and that is what the bond is known, that the capital protection and the stable income it is being offered. Now 41 to 60 is again 5 lakh, and 60 and above is also 5 lakh. So that is what the whole proportion is. And when we look at people who are the young youth of the India, less than 30, it is hardly 2 to 3 lakhs. But 2 to 3 lakhs, what we see now, most of them are coming through this OBP, where the digital onboarding, visibility in terms of the bond central, India bond has made them enable, and the platform like a DLT, which will be a future for the retail investor to know, has paved the way for these people, where we can see more and more traction will happen.
Thank you so much for giving a very detailed picture on the DMAT holdings. My next question is that both OBPP and RFQ are a tech initiative. And the move is to shift bond trading from a traditional OTC sort of market and use technology to draw more investors. So, Aditi, would you give your views on how we can use technology to improve the access to investors on the OBPP side?
Thank you, ma'am. That's a very, I would say, interesting question, and that's the need of the hour. Tech is a part of our life. Today, without mobile phone means you don't exist. We look for our mobile phone the first thing when we wake up. So technology is a need. And if the technology is a need, then it's a need for the debt capital markets as well. With OBPs coming in, with the guidelines coming in November 2022 or 23, I'm mixing one of the years, that enabled the connecting the exchanges, clearing corporation with the investor. So today you do not have to pick up the phone and talk to your broker and say that I want to buy this bond, or I want to invest, or I want to sell the bond. You can please, at your own free will, 24/7, go on to any of the registered OBP platforms, decide which bond, decide where you want to invest, how you want to invest, how much you want to invest, read up, be very aware of, as per your risk appetite, whether it suits your investment portfolio. And through the payment gateway, you can make the payment and you can sleep peacefully. Clearing corporation is going to settle that bond and transfer that bond into your demat account on the settlement date. So this is literally having control in your hand of knowing where you are investing, why you are investing, and how you are investing. Now, what we are looking forward in times to come, and since we have the, I would say, the pleasure of depositories in the panel, that we are looking at the sales transaction, that is transfer the bond. Because the idea of coming to a capital market for any investor is not only invest, is to invest and to disinvest when they need money. So your disinvestment or your sale transaction should also be as simple as investment. So today, if your investment is 2 minutes away, your selling should also be 2 minutes away, which I'm sure in times to come we are going to see that. So that's how technology has empowered the investor to make the right decision at their time, at their liberty, and having the security that the money and the security is going to go straight from their account to the clearing corporation and back to their account if in case it's a payout and there is no intermediary involved. So that's how we feel, ma'am, the technology has enhanced the depth of the bond market.
Thank you so much, Aditi. Taking this question forward, when I looked at the trading volumes on RFQ and then OBPP, I believe is a subset of RFQ, I believe that the trading volumes you are able to attract are still on the very low side. So my question is, despite the very low volumes, we are seeing instances of tech platforms who are unregistered also wanting to get into this space. So what is the attraction for tech platforms to get into this space? And how would you, how does tech platform, so that's a question for all investors who are creating these platforms. What is your revenue source primarily? How do you make it a paying business? And this is a question for Tirth and Ajay ji also from the investor side.
So just to add one thing, Tirth, I'll just say, the volumes may be low, but one data which I would like to highlight. In 2023-24, the number of RFQ trades was only 44,000. While in 2024-25, the number of RFQ trades is 276,000. And I would say this jump in number of RFQ trades can be attributed to OVPs like all of us, because our per trade may be less. The volume, your value of transaction may be less, but the number of transaction is increasing. This means there is a horizontal expansion, and we are trying to reach out to people. It's to you.
I think so that's a very good question, ma'am. So over a period of time, if you look at, I'll start with a holistic picture. So a corporate bond market for a country like India is much less when I say to other compared countries. So first, I see that there is a lot of opportunities. If I look at the market, our market is 70% to our GDP. When I look at developed countries, it is more than 100 to 120%. So first, the opportunity is there. Second, as rightly Aditi said, then in last 1 year, the overall transaction has jumped by 8 times. If I look at the volume, it was 900 crores in FY24, which is FY25, it is 3,300 crore. And this is just OBP numbers. So this number shows that people are coming on to OBPs, and this part of business is attracting a lot of investors to start the platforms. So now what is happening is, ma'am, one more data. So if I look at the RBI retail platform, they have published the data. In 1 year, their volume has gone from 5,000 crore to 7,000 crore. There are 5 lakh registered players or individuals on RBI Direct platform, which is showing that country like India, there is a definite interest for instruments like fixed income or GSEC bonds. And this is driving the platforms, unregistered platforms, to come and show this product to a lot of investors. Ajay bhai, would you like to add?
Today, to reach out to the retail participants, you need a technology, you need a platform. You just can't go physically reach out to the people. Like 140 crore population, which is a population of India, out of which how many are the investors? As I see, there are only 20 crore demat accounts. 20 crore demat accounts, and out of which 4-5 crore demat accounts has just got added in the last 12 months. So this is rapidly expanding. This is an investment being made by people who have a vision. Vision is created by our Honorable Prime Minister, Mr. Modi, that we need to make India progressive, and we all are responsible to walk along and make sure that we have enough infrastructure built around to have people put in their savings into a productive use. Now, if you look at it, who is the largest state having the maximum number of demat accounts? Probably everybody will say Maharashtra. Yes, this is Maharashtra. Who's number 2? All will be surprised. Number 2 is UP, right? UP is number 2, not Gujarat. Gujarat is number 3. So the way demographic changes are happening, the way people are becoming conscious, they've seen their returns being made in the equities. Now they are careful. After making their returns in the equities, they would like to conserve it. Once they have enough money, they would like to conserve, they would like to grow, they would like to be responsible in their investment activities. And bond platforms have a responsibility to ensure that they communicate very clearly as mandated by SEBI. That we publish all the information, we get the rating rationals available to the investors, we get the balance sheets available to the investors, they take an informed call. The more education to the investors is a better informed call, and that will enable. I see bond market where equity market was 20 years back. And the way equity market is expanded, I have no reason to believe that that market cannot.
Thank you, Ajay ji. You just mentioned the investors doing due diligence and being aware of the risks in investing in bonds. On this topic, I would like Prashant ji to speak a little bit on the securities covenant monitoring system and then Bond Central, Aditi.
So in single word, if I have to define what securities and covenant monitoring is to be, basically the project started under the guidance of SEBI as a part of the DLT platform developed by NSDL. It is nothing but the single source of the truth. That is what the right articulation of what that platform is offering. Basically, when the money is raised against any bond and then the assets are created using that money, there are many questions which come forward. One, whether the assets are genuine, whether the assets are shown as a duplicate against the different bond. Secondly, the valuation of the asset is happening properly. Whether any liens created, they are getting recorded in the system. And the answer to all that is nothing but the DLT platform. It is based on the blockchain, so it is immutable. And definitely it is the authoritative data where the every charge created has assigned a unique ID of 12 digit. There also the logic prescribed. Moment the charge is asset is created, it is a responsibility of the debenture trustee to update the details about the genuineness. Regular periodic review on the yearly basis, that is what also being made available. So basically the DLT platform has become a complete source of information in terms of the various stakeholder, issuer, debenture trustee, credit rating agency. And now when the data is getting gathered, so more than 600 issuers are there, more than 10,000 assets are created. Now it will be the journey where we will see the various information in terms of cash flows, in terms of the amendments in the charges will happen. And then it will be the use case for the retail and institutional investors where they will know about what exactly that bond is behaving as and when they are planning to invest into that bond. So that is what the whole thing which the DLT platform has brought into the picture.
So taking forward from where Prashantji left, so DLT platform tells you whether your bond is secured and they are taking care of the security, and I think our depositories are doing a phenomenal job. And so at the same time in February 2025, knowing the fact that for any investor, what is important is unbiased, uncolored, true information. To empower investors, under the guidance of SEBI, OBP Association launched a website called Bond Central. There, it's a free of cost. Anybody can log in. Find the details of any ISIN. ISIN is a unique number given to every bond issuance. So you can log into the website, find any ISIN, look into the data details of that ISIN, understand whether it is secured, unsecured, what is the security, what we call as the issue documents, you can find it there. You can see the current price of that bond. You can plot a chart of that bond price against the GSEC pricing. You can see who is the debenture trustee. You can see who are the stakeholders, who is involved in the issuance of this bond. This initiative has been taken to empower the investor with the power of information before taking any decision. So this is one initiative which we, as association under the guidance of SEBI, we will keep on enhancing on it and we keep on taking feedback. So we feel that Bond Central, like an MF Central, can be a one-point source of information for every investor.
Thank you, Aditi. So what I get from the responses of Aditi and Prashantji is that bonds which were somewhat perceived, sometimes are perceived to be complex, not so easy to understand, and have the likelihood of default in case the issuer is poorly rated or performs badly. These two technology-based initiatives will go a long way in simplifying and giving confidence to investors on exact quality of bond, and also throw some light on why certain bonds are priced high, why certain bonds are priced low. Now, we have heard of the opportunities available in this bond market for growth, considering how fast equity has grown, considering the volume of issuances, but the lack of trading. So given this opportunity, I would like each of the participants, we can start with Aditi, to make one suggestion which they feel would make a huge difference in growing the bond markets.
Thank you, ma'am. So for any financial asset, there are four pillars: the depth of that market, the liquidity of the market, funding of that asset, and awareness. We feel today in India, any financial asset, what we call as FD distributor, insurance agent, mutual fund distributors, equity sub-brokers, authorized persons, the distributor network in financial assets makes a big difference because we are a very, very diversified country. If we look at, we are probably a whole world in one country. So if we have something around distributor network for debt instruments, it will help us to create awareness and it will help us to educate investor what could be the alternate way of making the same fixed income other than investing in FDs or just a Kisan Vikas Patra or the post office FD.
To the question, I'll say, let us go 10 steps back. I think so, the biggest thing that can help bond market grow is education. I think so, colleges and should be mandated to have bonds as the part of their curriculum. I think so, coffee table talk should move from equity to bonds. Once that starts, I promise the market is going to grow like anything. Because today what is happening is a lot of people are not aware what is happening, and that is reason that is keeping them away from coming to the market. Once we educate, once we improve the ground level, people will start coming to this market.
I agree, but I have another suggestion, like bond market in India, we can educate people, they can understand very well, they want to trade, but where is the liquidity? Liquidity is the biggest challenge in the bond market today. Anybody who wants to buy, all are there to sell, but there are hardly people who are interested in buying when people want money. So liquidity is the biggest constraint in our bond market. If the liquidity is improved, there are certain measures which can be taken to improve the liquidity. It could be like larger institutions or the online bond platforms can create some pool of liquidity. They can get the cheaper financing from the banks to have the liquidity against the bonds, which probably they end up buying from the investors who are looking to get the liquidity. Third point for the liquidity is once there is a liquidity in the underlying bonds, the OIS and the kind of CDS, which is credit default and interest rate swaps and all that can play well. Underlying bond is not liquid means all of those things will not work. Though these are not for the retail investors, but retail will work when the institutional investors are able to hedge and provide liquidity. So it's chicken and egg, but thing is that we need to work towards making bond market a lot more liquidity. Today, equity, any amount of equity you can buy and sell with some price impact. But in the bond, we have seen the days where the bond market just got frozen. And thanks to SEBI and thanks to Finance Ministry that they've created a AMC repo platform, which is still to aggressively take steps to provide liquidity into the bond market, especially the 30, 40 active players in the market who needs liquidity and can do wonders. It should be done. Another valid point which could be, I'm very impressed with the Bharat Bond as a scheme which was launched 7, 8 years back, where in a basket of the bonds who have zero risk, AAA Navratna companies, and there was a basket created with kind of almost zero fees, no transaction cost. And that has done wonderful job in terms of getting channelized the retail money and all of that. Today, on those lines, if somebody is willing to take steps to create a basket of the bonds, like selecting an individual bond by a retail investor in the smaller quantum is a challenge. But you can always buy a basket of 1,000 rupee bond, which has a 10 such papers. It could be NBFC, it could be financial services, it could be bank, it could be any manufacturing company. So that ETF works extremely well. It's a low cost and have a liquidity around it. The other 2 points probably I would like to add, and liquidity is something which will create wonders in the market.
Traditionally, the trend in the retails is like that if there is any tax saving, they will jump into that. So India has seen national saving schemes, small saving schemes, ELSS of mutual funds, pension schemes. Now then equity market has seen Rajiv Gandhi equity saving scheme. And there used to be many years back the tax saving bonds which used to come and people used to jump into that. So why not we have something like a tax saving scheme where tax saving bonds offer a interest to be non-taxable, but the investment is not. So if we can start with that, where already all the benefits of FDs and other markets are there, we can see the jump happening at the beginning only because we are looking for the retail investor to participate.
I think to add to that, Prashantji, I would say tax-free bonds actually created a miracle in the retail market. So yeah, so tax definitely matters to all of us.
Apart from the tax-free bonds, one more point is that on the equity, taxation is very simple. It's differential, it's low taxation. Long-term capital gain is 12.5%. Short-term capital gain is 20%. It's a subsidized tax rate, not as for the slab. Whereas there is a stepmotherly treatment to the bond investors, you are supposed to be paying as per the slab. So the highest tax rate in a bond investor, where the returns are low, you end up paying 42% tax. Like 6% FD, you end up paying 42% tax on that, and you hardly get less than 4%. So it's a dissuasion from making investments in the bond with a higher taxation. Why not we have a equity-like tax rate for the bond investments? Complete tax-free probably is not something we can look around, but similarity with the equity will make a big difference.
Good ask, Ajay sir.
So some very, very useful and practical suggestions. I have one last question, given that we have just a few minutes left. You said that tax-free bonds did a miracle for retail markets. Is there any particular reason why we don't? So the best way to invite retail to get into bonds is through public issues. What should be done to encourage more public issues? Is there any response to that?
Public issue is probably the best way to access, for retail market to access the debt market, because the face value of that bond is ₹1,000. Because the smaller the investment value, the easier is the retailer to reach out, to invest. Second is, in case of a public issue, there is no constraint on number of investors, like a private placement. So it is meant for public at large. So there is a lot of marketing, there is a lot of knowledge sharing that the issuer does. There is a lot of media coverage of that public issue, and people understand the issuer better. In that, there is a huge distribution network which gets involved, because there are people who go and talk to their investors. So public issue, if encouraged, and somewhere we need to look at public issue of bonds in light with the FD. And there are certain benefits in FD market also to senior citizens, to women investors, to repeat investors, to recurring investors. So if similar kind of facilities can be provided in the public issue, it will encourage, because in one of the conversations Prashantji mentioned that when we look at the demography, the people who are coming into the bond market is 40 plus. They are going for their retirement planning or their financial planning. So if they have such kind of an additional benefit, it will definitely encourage them to access this market.
I think so, ma'am, it starts with both the ways. So as an OBP, as a regulator, I think so we should work together, because if we look at the market today, 95% happens as a private placement and only 5% happens as the public issue. I think some mandate should be given to the companies, or companies should be pushed to bring out more of the public issue, because as Aditi ji said, as Prashant ji said, it is beneficial to the public at large. So I think so it becomes a cumulative responsibility as OBPs, as the SEBI, that we can work together to make it possible.
I think it's the merchant bankers who are active in the debt market need to work closely with regulators like SEBI to have a seamless process for the public issue. Public issue process takes a little longer time than the private placement. It's slightly cost inefficient also. We can work towards improvising the cost escalation and timing and the size of the prospectus. We just closing a public issue of our company today. It's a 918 pages offer document. We need to cut it down.
But Ajay, I will say one thing that right now public issue is going on for Surat Municipal Corporation. Because of the guidance of the regulator, the listing is going to happen in T+3 days, which is very good because in debt market, your money is your currency. And the number of days the money is lying in the account without paying you interest, we all are unhappy about it. So T+3 listing was a very, very welcome move.
Definitely the investor education will be of prime importance for this whole market to move forward. In fact, a year back, SEBI has come up with a liquidity enhancement window. As a part of that, the bonds where the liquidity is not there, it will be obligatory on the issuer to purchase it after a predefined time. So now we are at a stage where the exit is also available and the capital protection is there. So more and more education definitely will be helpful, and people prefer to have the investment in the PSU municipal bond. So such a bonds with a less face value could be the added benefit for the investors.
Thank you so much for some very, very useful suggestions, which all of us will take back, including investor education, distribution for bonds, better tax treatment, or I should say more equitable tax treatment, get better liquidity. I like the idea of ETFs very much, and suggestions on making the IPO process more efficient in terms of cost, as well as process, I think. Thank you so much.
Ma'am, me and Aditi would have done the highest number of public issuances. So are very much aware about where the things can be improved. But the thing is that it cannot happen overnight. It's a process, it will take some time. But there is a path which can be traveled.
Thank you so much. We are open to questions if the audience has any questions.
We can take one question. We'll take the first one here, sir. We'll have a microphone sent to you. Please do introduce yourself and ask the question.
Hi, Girish here. So I am just checking, like in case of bonds, the biggest risk is the default risk. Like recently, this Billy Smart Mobility. So your money becomes zero. Like that, you don't think it's the highest risk. In equity, like sometime it can go 10-15% down, but becoming zero is like the biggest risk. So how you like counter it?
Sir, I would, first of all, thank you for the question. Let's put it this way. Yes, default risk isn't anything. It's like a life which is going to end someday. So I would disagree to the fact that equity, there is only a price fluctuation of 10% to 15%. We have various kind of stocks. We have seen a lot of stocks going to zero also. So default risk or the credit risk is definitely a risk, and that is why there is something called as a credit rating. So we encourage everyone to look at the rating of a bond and read the rating rationale. And the rationale will specify the risk associated. And depending upon the risk you want to take, you should choose the bond you invest in. Similarly, you have a large cap equities, you have SMEs, you have penny stock. So it'll depend on the category of the bond that you would choose. I hope that answers the question.
Hello, this is Anil. I just wanted to know, like, as we have tips in US, like for inflation protection, do we have some product here in India?
The yield of every bond is inflation protection.
it's
Because
something like-
today, if you go to a GSEC also, I'm not going to give you accurate pricing, but your 10-year GSEC today is approximately around 6.5% to 640. Inflation today in India is not even at 4. So you have a positive carry there as well.
No, it's not guaranteed. So inflation can go Hawaii anytime kind of stuff. So something like
I think our ministry is doing
something
a...
like index there used to be index index bond kind of something previously, which I don't know currently is available or not.
That is not a product right now which is linked to the inflation, but it is a very good suggestion which we can always put to the right authorities to see that in the past we have had an inflation adjusted, which you are rightly pointing out, that the index bonds, we can always put it out to the right authorities that inflation can look at it. Ajay Bhai, if you want to add.
These variable rate options are usually not very liquidly traded. Most of the investors doesn't want uncertainty in the interest rates. They say that they are aware about the inflation, that's why they are kind of making an investment call in the fixed returns, and attempts have been made throughout the time period, and eventually the central bank has to buy back those bonds to redeem, but they are not very popular. In government securities, there have been various times the inflation adjusted or variable rate options, rate to be decided every year and all. Today, if you look at it for the retail products, central bank is offering GSEC plus some return on an 8-year paper, but that is not liquid. So I would say people would like to participate in an option which is liquid, and inflation as such in the last 7-8 years you might have seen is anchored. The central bank's mandate is to anchor inflation close to 2 to 4% range, and they've been successfully able to anchor the inflation. That's why we see steady improvement in the yields.
But I still find that is a requirement, because personally I'm in finding this kind of product for quite some time.
I think so. There is floating rate bonds that is issued by RBI, where rates keep on changing periodically. Apart from that, we don't see any inflation-linked products that is available as of now. Thank you.
Thank you.
Thank you so very much for your participation in the questions and the queries. I'm so sorry, due to paucity of time, we'll have to take a call right now. But I do request each and every one of you to please give all our esteemed panelists a nice warm round of applause as I welcome you forward up in front of the stage for a group photograph, please. Ladies and gentlemen, once again we have Ms. Aditi, Mittal, Mr. Ajay Manglunia, Mr. Prashant Vagal, Mr. Tirth, Shah, and Ms. Maninder, Cheema, our moderator. We thank each and every one of you for your insightful conversations and compelling discussions that we've had, and each and every one of you, ladies and gentlemen, for your participation.